Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I think I've pretty much covered this. So, as I said, there's a lot of areas we could go in. There's a lot of back and forth on parsing the economic theories in here, what makes sense and what doesn't make sense. But we think the unemployment problem really is the key. Before we see any type of before we buy in hook, line, and sinker to this recovery in the U.S., we'd really like to see this improve. This shows the unemployed persons in the U.S., number of unemployed, and you can see the massive, you can see how the jobs got wiped out. This is a number of unemployed. And this is the official numbers. The unofficial numbers are much larger than this. And if you factor in what's considered the underemployed of U.S. workers, way underemployed relative to their skill level, I think you can add a lot more to this chart. We start to see a little bit of improvement in here, but again, not that much given that a lot of the economists, a lot of the analysts have told us that we're completely free and we're growing again. We're still very concerned, to tell you the truth. But this has been, the wipeout in jobs here because of this credit crunch has been to the degree and the speed that we've never seen before, and that's another reason that we say this isn't your grandfather's business cycle. Something has changed here in a very big way because of the debt overhang in the global economy. And until we see this improve a little bit better, we're not going to buy in yet. So I think the U.S. double dip scenario really still has to be in play, especially if you consider what's going on with the likes of Goldman. Now, something like this really could spiral into and hit the stock market in a big way, as I said, and hit the wealth factor and everything else. If the SEC spreads its wings here and goes after other firms, which I think there's a pretty high probability they will, then this tends to push further down on credit, which means the small business isn't going to get those loans, which he's not getting anyway, but the chances fall even further. And I made this little notation here. The last small business survey for March actually showed things deteriorating from a small business standpoint. And that's really critical for the U.S. economy. It's the small business that creates jobs. So the fact that we're seeing small businesses actually become a little more pessimistic in the latest readings on their surveys is not a comforting feeling going forward. We also saw jobless claims in the last major report. They were worse than expected. So this isn't improving to the degree in which everybody seems fat, dumb, and happy about this recovery. So it's something we're watching closely. We call this chart the Euro spiral of death because there really are three factors that are pushing down on the euro at the moment, which we think the euro grinds down to par against the U.S. dollar or a lot more. Start up here, and we see this happening. The default risk premium rising. The euro was very much an artificial construct in that the economies that were tied to the euro, part of the European Monetary Union, were able to borrow at the same rate Germany was, or slightly above Germany. Now, there's no way in God's green earth that Italy, Portugal, and Spain should have ever been able to or Greece, needless to say, ever should have been able to borrow anything near German interest rates. But that was one of the major artificial constructs of the European Monetary Union. It wasn't until the credit crunch that we finally started to see these premiums start to change, where the market started to price in some risk in the European Monetary Union. We kept waiting for it, and it finally started to come about. Now it's starting to happen in a very, very big way. So the default risk now is rising tremendously for Greece. The spreads now have reached an all-time high between the Greek 10-year bonds and the German Bund 10-year 10-year bonds. That's an indication of rising risk premium. It's another reason the euro got hit a little bit again today. Big meeting tomorrow. The muckety-mucks of the European Union are meeting with Greece about extending this loan facility. But what we haven't seen is this risk premium soar for those other countries that we think are in as bad or worse shape than Greece. So we don't think all this default risk is yet priced into the euro. We think at some point it will, and push it down even further. Monetary union incentives. Germany is the core of the European monetary union. Germany was the D-mark was the anchor currency that created the exchange rate mechanism, as it was called initially. One of the reasons the European Monetary Union was created, so it would be a captive audience basically for German industrialists. That really was one of the bottom line, and it's why Germany gave up its D-mark. They're not going to give that away for nothing. They gave up the D-mark for the euro precisely because of that. Over 50% now of German exports go to the Eurozone economies, much more than they did before the European monetary union. Obviously, it's a lot easier, the cross-border mechanisms and everything else. So German incentives to subsidize the union, which they've done all along, the weaker countries, basically allowing them to tie to their credit and borrow, has been there in a big way for Germany. But right now, for Germany are fading tremendously. And they're fading because of the fact that we're seeing demand come out of the Eurozone economy because of all these problems. We're also seeing the demand for German credit and backing and backstopping of all these fiscal basket cases rise. Now, it's political suicide for Angela Merkel, the head of Germany, to use German credit to backstop what's going on in Greece and these other countries, because she sees the slippery slope. This is one of the reasons why the International Monetary Fund was called in. Germany said, we're not backstopping these guys. It was something that Trichet, who's the head of the European Central Bank, expected Germany, France, and the others to step up and handle this problem alone by providing direct loan guarantees among the individual states. But Germany balked because the incentives for them in the union are fading. Their citizens are sick of it. They're sick of paying for the rest of the European Union. But they've gotten benefits from it, Germany, as I said. But as demand declines in the years ahead, because austerity is the only seeming way to get out of this problem from these other countries, you're going to see the demand for German exports inside the Eurozone on a relative basis decline. So why does Germany stay here? There's less and less a reason to that happen. It's not out of the realm that we may wake up one day and they've already opened the door to this and even discussed it. In fact, there's a lawsuit about to start which says that by some citizens in Germany, some law professors that have been against this for a while, that are suggesting that Germany should not transfer any more money to Greece or the Eurozone as part of the European Monetary Union, because it's impacting Germany negatively, which is part of their constitution when they created the European Monetary Union. So that little signature in the back door is now starting to come through the front door and create a problem here. So we could wake up one day and Germany is gone and continues to say they're gone. It means the euro as it is would dissolve. The probability of that happening near term is still slim, but it's increasing again, that probability.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.